Over the past 36 hours, the United States and its partners have launched Operation Epic Fury, one of the largest, most complex, most overwhelming military offensives the world has ever seen. Nobody's seen anything like it. We have hit hundreds of targets in Iran, including Revolutionary Guard facilities, Iranian air defense systems. Just now it was announced that we knocked out 9 ships plus their naval building, all in a matter of literally minutes. Iran's formerly supreme leader, Ayatollah Khamenei, is dead. This wretched and vile man had the blood of hundreds and even thousands of Americans on his hands and was responsible for the slaughter of countless thousands of innocent people all across many countries. Last night, all over Iran, the voices of the Iranian people could be heard cheering and celebrating in the streets when his death was announced. The entire military command is gone as well, and many of them want to surrender into saving their lives. They want immunity. They're calling by the thousands. Combat operations continue at this time in full force, and they will continue until all of our objectives are achieved. We have very strong objectives. They could have done something 2 weeks ago, but they just couldn't get there. Earlier today, CENTCOM shared the news that 3 U.S. military service members have been killed in action. As one nation, we grieve for the true American patriots who have made the ultimate sacrifice for our nation, even as we continue.
So that was the U.S. president, and that is his latest statement saying that we will avenge those U.S. deaths. Hello and welcome. It's a Monday morning and it's been a very, very busy weekend. You're with us on Opening Bell. This is Moneycontrol and I'm Surabhi Upadhyay. As we get started and introduce our first set of guests, let's just quickly tell you what the markets are doing. The market reaction, you'd have to say, across the board, pretty much, whether you're looking at gold, silver, whether you're looking at Asian equities right now, is actually measured. Markets have been given about 24 hours, more than 24 hours to digest what has happened as this war rages in West Asia. Let's quickly pull up the hot boards. So you're seeing about a 2% bid up on gold. We've got about a 5% rally going on oil prices, on Brent oil. And Asian markets are down between 1 to 2.5%. Nikkei is down about 1.5%. The Hang Seng is down a little more. It's down about 2%. And the GIFT Nifty, of course, is suggesting that we will have a cautious start. There's plenty to cover. Let's get started. And oil is the central point. So I want to open by bringing in my colleague Manisha Gupta, who I'm sure spent the bulk of the weekend tracking these developments and making those phone calls to figure out what will be the risk premium on oil. But Manisha, at 5%, and I don't want to sort of tempt the gods, I dare say this doesn't seem as dire as what we were fearing, watching those headlines and watching those missiles.
Sylvia, I'll go to your opening comment itself, that markets has had time to digest all of this and is the reason we're looking at that measured reaction to this one. But let me tell you that in history, it has been only about 5 times that you have seen crude oil prices gained up by 10 to 15% in a day. And today was one of those days because we started with that knee-jerk reaction. The initial 5 or 6 minutes was a 13% hike that we saw in crude oil prices. So we opened at $82 a barrel. I mean, that was various traders adjusting their positions on what really had happened over the weekend. So we did see those gains come in. And then, of course, the markets do believe, one, that it is not the peak demand period. So there is enough crude oil prices, crude oil availability. 2, no crude infrastructure facilities have been hit right now. And third, you have had OPEC Plus to come back and increase production from 1st of April by 200,000 barrels per day. So the markets do know that there is crude availability. But then again, it's still a fluid as a situation. There are 2 things to watch out for. One is the Strait of Hormuz, of course, because this is where nearly 20% of crude flows from. So even as Iran continues to tell us that they have not closed it, but insurance companies have been warning shipping companies that they will either hike premium or cancel policies if the ships do go by that way. So that means there is going to be a disruption and longer routes when it comes to crude there. The second is about Iran retaliation to the neighboring countries. So these are two factors that can continue to keep the crude prices on the higher side. Another thing will be to watch is that Iran exports 3% of global crude. So if Iran does not export, and those numbers is something that we will continue to watch out for. So if there is a concern onto that one, then you're looking at crude prices gaining as well. So it's a fluid situation, but at this point in time, it's a measured response that the markets are giving. It is still reading into everyday bites, situation and statements coming in from everywhere.
I just want to sort of, point our viewers to that little map that we've shown. Imagine it's such a narrow strait, right? And the entire world market flashpoint has come down to that. Apparently, at the narrowest point I was reading yesterday, Manisha, it's only 33 kilometers wide,
That's right.
the strait. And that's where the ships are piled up. But I mean, just quickly to wrap it up, is the sense that this is an initial reaction, but if Hormuz doesn't open quickly enough, could it get worse before it gets better? Or is this it? Have we seen kind of the worst hit already? Because the war is still on.
It is. And if we've all been hearing the US president who said that next 4 to 5 weeks is what can continue as well. So I don't know how this is going to play out going forward. Is the worst behind us? We don't know that. But the Strait of Hormuz is something that we all have to keep an eye on if we are looking at crude oil. So as Surbi mentioned, it's a very, very small place there. Ships on both sides are still standing. And it's the insurance companies that perhaps would take a call onto this one. As we've been saying, 20% of crude passes through that, and it's a huge amount of gas that passes through that as well. Natural gas prices have gained up by 10%. They seem to be holding those kind of gains there. Qatar is your major country where the gas passes through. So if the gas from Qatar does not go through, then we are looking at the gas prices gaining as well. And if this gets prolonged, if the ships are not able to cross through that, that is when you will see the reaction come in for the prices. So there are three scenarios to look at. One, Iran export stops, you're looking at 90. Strait of Hormuz, a prolonged shutdown and the ships continue to stand where they are, then again you're looking at 90 and 95. At this point in time, while of course the markets are still reading into this, if Strait of Hormuz opens tomorrow or next week or something, it's not the damage done, but that still is out and fluid. And I can tell you one thing, Surbi, there are no shorts in these positions. The longs may be getting close, people may be taking profit from those higher levels, but there are no shorts being created here.
Okay, absolutely. So that's the oil market. We're watching for it very, very carefully and closely. On gold, Manisha, just to wrap up the rest of the commodities, and again, 2% could have been any day.
Yeah.
You can't believe there's a Persian Gulf war raging with, every party involved, Israel, US and all these Gulf countries. Gold is up 2%. You can argue that it's already rallied, well ahead. But what did you make of that?
But that's exactly my point was, Surbi. The crude prices also, for example, had been surging. It's up 25% in this year already. So we knew something was going to happen. Gold as well, the reason it started coming back from that 4,900 to 5,300 is where we are trading right now. So the market in anticipation have seen that war premium already building up into prices. And then from here on, we'll watch news and all. And if something does happen, we'll be looking at prices going higher. So from where gold stands right now, it's just $200 away from all-time highs, and markets do believe that 6,000. And in 2 years, there is a $10,000 to $12,000 an ounce also of a target coming out. So JP Morgan and you have HSBC and UBS all telling you that 6,200 is where you could be looking at gold in this year. Geopolitics, tariffs, you name it, and you all have it.
Commodity queen. And she's had the last laugh all through 2025, and the way 26 is shaped up, it's only hard commodities. Manisha Gupta, thank you so much for being with us this morning and giving us some very, very important context. Well, with that, let's quickly move on and welcome in our next set of guests. We've got Vishnukant Upadhyay joining in on the technicals this morning, and Ashish Chaturmota to give us a fundamental perspective of really how this market is dealing with this huge geopolitical issue. Apologies, first of all, to both of you gentlemen. We had a bit of a technical glitch, got a little delayed. I think the systems are also taking in the amount of news flow that we've had over the weekend. But Ashish, great to connect on Moneycontrol. Let me open with you. It seems, I dare say, a very okay kind of a morning, a measured morning, 1-2% equity drop. Is this the worst hit? So is the morning itself presenting a buying opportunity? How would you approach it? Ashish?
Good morning, Surbi. So I think, yes, Mark, the way, the correction has happened on a day where we have seen crude going up by a good 5 to 7%, gold has also seen a good recovery. Obviously, not to the extent one would have expected, because typically in these kind of situation, ideally gold should have done much better. But as rightly said, gold has been doing so well for the last 1.5 years time frame, including other precious commodities like silver and all. So I think it's more or less getting discounted into the price. But definitely, I think word of caution is required at this juncture, because if crude starts to do well and crude continues to rally from current levels to maybe, let's say, 85 $90, then I think that's going to really hit us, because then the inflationary pressure will start building in. And already, if you look at from an interest rate cycle also, it looks like that the interest rate cut to some extent has bottomed out, and it looks like, from here on we don't expect any further cut in interest rates. So this is going to keep inflation at a higher end. So in terms of margin profile for a lot of these companies, particularly in the manufacturing and capex side of the story, this might get impacted at least for some time. From a market perspective, it looks like, markets are going to trade in a broader range between 24,000 to 26,000. We don't expect Nifty to even breach 24,000 in the immediate short to medium term. Purely the reason is the earnings. The earning momentum has been really good in this quarter, where small caps have posted double-digit profit growth, and even the large cap and mid cap in terms of top line growth has seen close to 11% kind of top line growth. Obviously, there's been big support from financials and oil and gas as a space. So I think this will keep market in a tight range between 24,000 to 26,000 broader range, at least in the immediate short to medium term.
Okay. Take that point. I just want to tell viewers also additionally, what we had on Friday on Wall Street was a total risk-off before this event happened in the Middle East. In any case, we had a hot inflation report, producer-level inflation, and that was driving a lot of risk-off. Markets down, Nasdaq, S&P 500, all were down 0.5% to 1% anyway on Friday. And futures right now are suggesting, that is Wall Street futures, that there will be a drop between 0.5% to 1%, not more than that, at least as of now. But we need to watch for two things: the dollar index, which is continuing to inch towards 98, and we should watch out for the benchmark US yields as well. Because of that inflation report, anyway, the US 10-year yield had fallen to below 4% on risk aversion. And now we have this, brand new geopolitical, flashpoint across West Asia. So that's the dollar index this morning. It's not surging or anything right now. Like I'm saying, if you look at the way markets are reacting largely, they seem to be taking it in their stride. Vishnu, hi, morning. So very quickly, do you have an opening trade on the Nifty or on the Bank Nifty? Or will you avoid trading in the first couple of minutes or the first half hour, 1 hour? What's the approach?
Hi, Surbi. Very good morning. But perhaps this will not be a good morning for market traders and from market perspective. Yeah, definitely market is set to, react from the Middle East development and strengthening oil prices.
So very quickly, do you have an opening?
Yes, definitely,
Yeah, please
definitely.
continue.
Definitely. There will be a short position in the Nifty if we find levels somewhere around 25,100, because market is set to open somewhere around 25,050. So definitely we have a short view on the Nifty.
You have a short view on the Nifty, and what would the target be for that short trade, Vishnu?
Yeah, definitely in short term, we are set to, market is set to extend this ongoing losing streak towards 25,000, and which if broken decisively, 24,800, 24,900 will be on card very soon.
Okay. All right. Ashish, that's the question that a lot of people will have on their minds today, whether to look at these shorter term intraday moves and look at these, short trades, or maybe a knee-jerk long trade on an ONGC or an Oil India. Should one be looking for these short 1-day, 2-day trades? Or is this a great opportunity from a portfolio perspective to start going and buying? I mean, what would you advise both sets of people, the traders and the investors?
So, Surbi, I think some tactical longs here and there that those kind of opportunities will always come in, particularly in these kind of environment where you see a lot of volatility coming into crude, gold, silver. Obviously, it is going to positively impact stocks like ONGC and Oil India, and obviously it is going to impact oil marketing companies like HPCL, BPCL. But we need to understand a lot of this is getting already discounted into the price. As a trader, what you need is a start, and if obviously the stock opens gap down, then those opportunity actually they don't get that incremental opportunity to make money. So I think one should look this as a structural bets, and where one should try to buy stocks which are delivering high quality earning growth in at this point of time and giving dips so that one can enter into this space. For example, the entire wires and cables as a space, it's a great play on the renewables, on the overall data center, AI, capex, manufacturing as a theme. And if you look at their growth, they are growing double the GDP's growth in terms of the top line, whether it's Polycap, KI, or Apas of the world. And I think the way they have maintained the margin in an environment where copper prices were going up clearly indicates the ability to pass on the prices to the end consumer. So this reflects the resilience in the profit metrics for a lot of these wires and cables player. So any dip would be a good opportunity for stocks like Polycap, KI, and APAR. And I think structurally this looks very, very promising because the entire data center opportunity itself is 35 to 40,000 crore for the wires and cables as a segment. So I think those kind of opportunities here and there one should try to look into it and try to grab on dips.
Okay, so wires and cables and a couple of companies in that segment. So those are some ideas that Ashish has already given. By the way, gentlemen, the pre-open rates are coming in. They're a little scary right now, so I don't want to pay too much attention. Right now, in the pre-open, the Nifty is down some 900 points. But let's just we should give it another 3-4 minutes and then wait for it to settle. So I'm not going to take too many rates right now. Obviously, I mean, we're going to be watching out for the entire oil and gas space. The one rate that does seem believable on the screen right now is actually ONGC. ONGC is up almost 5%. Thanks to this move on crude oil prices, and Oil India, both upstream players. Oil India is up about 3.5% as well. Nifty at 24,300. Like I'm saying, let's give this another 4-5 minutes and then we'll have, I think, a more settled pre-open session. Ashish, I want to come back to some individual segments where this whole West Asia issue comes into play. So if you're talking oil and gas to begin with, on ONGC, Oil India, would you be taking that tactical trade, long trade at all? On the flip side, if anyone has any positions open on oil marketing companies or, even if they have OMCs in their portfolio, they'll be wondering today, should I sell out or should I just let this pass? What would the advice be?
So honestly, on these kind of days, I would avoid any kind of fresh incremental positions, Surbhi, because most of it is already into the price. But yes, we have been structurally recommending, public sector, ETF, which is the CPSC ETF, which is a play on this entire oil and gas as a space, which has a play on the rising, power sector, where we have seen the transmission segment doing very well, and power players also, we have seen the demand is also started catching up in the last couple of days. So obviously power as a sector is going to do well, and that's where NTPC, Power Grid looks very promising. And then you have the defense space, where we have been consistently seeing indigenization segment going up, and which is leading to margin expansion for a lot of this PSU related defense companies like Bharat Electronics Limited and HL. So to play this entire basket, the ideal way is to buy the CPSC ETF, which has got all these components within itself. So I think even if one wants to take a tactical bet, if there is an opportunity to get into CPSC ETF, that looks very promising. I think a 15 to 20% kind of positional upside could be seen in CPSC ETF from a 3 to 6 month perspective.
Okay, all right, got that point. So CPSC ETF is an option that Ashish is recommending. Vishnu, okay, now let's talk about stocks. Right now, obviously, there's a lot of price damage on the OMCs to begin with. I am seeing BPCL down 6.5%, HPCL is down about 4.5%. Likewise for IOC. What would your recommendation be if someone has open positions on these stocks?
So definitely there will be very negative day for downstream oil companies like IOCL, HPCL, BPCL. So it's a knee-jerk reaction in the market. If someone has a position in these companies, then they can put a stop loss. So I can says the stop loss in BPCL. We are expecting that prices could although technical structure is a very great, and I believe there could be a downside in the stock towards 372. So if stop loss prices goes below 362, there will be a further downside, and prices could extend their decline towards 44. So the stop loss is suggested around 365 in BPC.
Okay. By the way, now the Nifty rates are a little more settled. The cut now on the Nifty is 2.5%, which seems, a little more believable than what we were getting earlier. Now, this is in line with what, say, a market like Hang Seng was doing in the morning. Hang Seng is down about 2% as well, and we're down about 2.5%. So now we've got all the Nifty rates coming up for you. Those are some of the losers from the oil and gas space. On the Nifty, barring ONGC, every single other stock is down. Something like L&T down 9.5% in the pre-open session. Now remember, there are a lot of Indian companies, including L&T, and they have a huge business in West Asia, in the Middle East. And L&T is one of those names. There are others as well. I mean, names like KEC, Kalpatru. Kalpatru, for instance, is down 7.5% as we're speaking. Interglobe is obviously a casualty as well because of all the travel disruption that we're talking about. But interestingly enough, a lot of the defense stocks are lower, at least in the pre-open they are lower, and then we'll see if sentiment around them turns. Something like Ixigo, Lee Travenues Tech, the company that operates Ixigo, again from the travel and tourism space, down about 4.5%. So yeah, this is the way defense is reacting right now. A lot of these stocks in the pre-open at least are lower at this point in time. Ashish, coming to you on something like L&T, Kalpatru, L&T, these companies that do have a significant West Asia presence, I mean, pretty sharp initial reactions. What are your thoughts around this?
So definitely, L&T has got a very, very big exposure in the Middle East. In fact, when we recommend L&T as a bet, I think the entire story was the Middle East, the way the capex was happening on crude and the refineries. So I think that definitely the short-term reaction on L&T is very much understood. And I think, but we need to understand from a capex perspective, the company has been sitting with very, very strong order book. So definitely short-term reaction is there, and it might even correct towards 3,800 kind of zone. But any correction below 4,000 to 3,800 would be an opportunity to start looking into L&T from a longer term perspective, because that's where a lot of buying opportunity will emerge. One thing I would like to add, Surabhi, on gold, because gold we need to understand, gold has been seeing a very, very big uptrend for the last 2 years time frame, and we need to understand, if you look at in the month of November, gold ETF saw inflows close to 3,700 crore. But if you look at in the month of January, the inflows has been almost 24,000 crore, which is equal to a equity fund inflow. So clearly there is a lot of traction which is getting built into gold even at current levels. And the way central banks have been buying or accumulating gold for last 5 years, they have doubled their positions in gold, at least in the volume terms also. So clearly indicate that gold rally will continue. So in this kind of uncertain environment, as an asset allocator, I think 10 to 12% kind of allocation to gold makes a lot of sense for a portfolio. Even at this juncture.
Okay, yeah, so that's what one has to keep in mind on gold. And on L&T, like you're saying, levels below 4,000 could be offering a good opportunity to enter. And this is for people who want to keep L&T in their portfolios, right? That's the sense you have at this point. Okay.
Yes.
All right, let's just go back and look at the screen. What do we have? 500 points lower. So this is now a more settled pre-open session. We're about 8 minutes after 9 o'clock. And the biggest cuts are coming in on Interglobe Aviation. Let's fire up all the Nifty losers now. So Interglobe Aviation down about 6 to 7%. Tata Motors, passenger vehicles down 6 to 7%. Remember, I mean, Tata Motors PV, actually the numbers are okay. The auto numbers, which we'll discuss in a bit as we go forward. But I guess, I mean, there is a global exposure there, which would be at risk as well. So that could be playing into it. L&T we've discussed. There are names like Adani Ports, NTPC, Trent, General. Just it's risk off overall. That's what's playing out. And again, ONGC is the only Nifty stock right now that's in positive territory. Everything else is down and the losers are on your screen. Vishnu, before we let you go, so top trades for today, stocks, index, anything, advice today?
Subhi, so my focus will be on the pant stock, like Asian pant, because the chart structure is also not good, and I believe the stock, should be approaching towards 20 to 90 sort of levels. So there will be a selling opportunity in Asian pants, although it is trading a very, very crucial support area, 23.55. But I believe this support area will be taken out and prices will be extending the loss towards 23 and 22.80. So I'm giving a selling recommendation in Asian pen. Stop loss should be placed below 23.95 and targets will be 22.80 somewhere around.
Got it. Okay, Vishnu, thank you very much for that. You have a good trading day and all the very best. I mean, it's going to be a bit of a roller coaster, I'm guessing, but let's see, how it progresses. Thank you so much for joining in. By the way, we have some queries coming in on our YouTube feed as well. So I'll take some of the interesting questions that are up there. Neelam is asking whether power grid is a hold or is it a sell? And Vardhu is saying, can banking and IT support the market? Let me ask Ashish. Ashish, first on power grid, I thought that's an interesting question because I think a lot of people are looking for ideas that can't be disrupted, that don't have a global face, that are not disrupted by AI. So you really have to look carefully. Maybe power grid makes that cut. I don't know. Your thoughts?
So,
and you
as I
mentioned data
mentioned,
centers earlier, so therefore.
yes, yes. And in fact, as we also indicated about the CPSC ETF, which has got very good exposure into NTPC, Power Grid, ONGC, Oil India, and some of the defense companies. So that's a combined. But if one looks into Power Grid or NTPCs of the world, we are very, very positive because the way the transmission space is, has been expanding, and we have been consistently seeing huge order book position for a lot of these players on the equipment side, whether it's Hitachi Energy or GE Vernova's of the world. It looks like the structural story on power is intact, and I think with this kind of uncertainty, the focus will shift a lot on the renewable energy space, and that's how once the renewable energy space comes into play, you need storage, you need transmission, and that's where again power grids of the world will continue to do well. So I think it's a very, very attractive opportunity with strong price to book. And if you look at the dividend yield also at current levels is close to 3.5%. So it makes power grid as a very interesting bet on any such dips. And Surbi, as I would recommend, even players like wires and cables looks very promising. Data center, we need to focus a lot on these themes as well. Because if you look at in India focused AI or data center themes will be a very interesting bet on depth. So I think that's how we look market at current juncture.
Okay, and what about the other question? This is Vardhu's question. Can banking and IT support the market?
Yeah,
I don't know about IT, Ashish. It's been such a difficult phase, right? February was all about this IT disruption. March starts with a full-blown war. Ye kya ho raha hai? What is happening in 26? So I don't know about IT, but banks and financials, can they offer support? That's what our viewer is asking.
So even IT companies, they don't know what's going to be the fortune for them. So I think it's a challenging time, and in such kind of situation, one should try to avoid this basket. Yes, it has almost 8% weight in index, but the important point is their profit pool contribution to the overall profit pool is going to decline, and that's where the market share is going to come down. But banking as a sector offers a great opportunity, and particularly the PSU banks, because the way they have been growing credit, it is in line with the private players. They are gaining a lot of market share on the personal loan, on the home loans side, and that's where they are getting very good traction in terms of NIMs. We have seen a very stable NIMs for a lot of these PSU banks, and if you look at the credit cost also, it is in a manageable level. So all put together with valuation, it looks like PSU banks looks a interesting bet. We believe State Bank of India, Canara Bank, Bank of Baroda all looks very promising. And if one want to play it through one instrument, then it would be PSU Bank B's ETF, which could be a good bet to ride this PSU banking rally.
Okay, all right, Ashish, thank you very much. Just 20 seconds to go as markets open out. Very, very helpful context and advice today. Our viewers will greatly appreciate it. You have a fantastic session today. Good day to you and all your investors. And we look forward to connecting again. Let's see what the end of the day brings. Thanks for joining in. Thank you. Okay. Before we bring in our colleague from Moneycontrol Pro, let's get to the rates. Anubhav Sahu is going to be joining in the next couple of minutes because MC Pro has been working throughout the weekend as well to analyze what the potential implications could be for the market. And that's the first rate. It's not a bad rate at all. It's a lot better than even what the pre-open was indicating. We've got a 1% dip on the Nifty. This could have been any session. It could have been any day. And that's what's very, very interesting, that markets have had time to digest the developments. The supreme leader of Iran is already dead. So the markets want to believe that this will be controlled. It will not be escalating in a very, very dramatic fashion, and it will not be too long, too protracted. And I think that's what's playing out on the screen right now. Nifty is down just about 250 to 300 points. It's a 1% drop. The Bank Nifty is down less than 1%, as you can see. The mid-cap index is feeling, a bit more of the pain. The mid-cap index is down at about 2%. As of now, obviously the advanced decline ratio is weak, but like I'm saying, this could have been worse. It's not such a bad reaction, at least as of now, but this is the first reaction and the war is not over. So we need to watch the screen very, very carefully. Let's get down to stocks then and see what's going on. Now on the Nifty, as you would expect, ONGC is up 4%. BEL has a bit of a green tinge to it. Defense stocks, sentimentally, I mean, you'd imagine that there'll be a bit of a green, and that's what you're getting. And then there's Hindalco on the upside. Let's look at everything else that's down. Interglobe Aviation is taking the worst hit. It's the worst performing stock on the Nifty right now, which is down about 5%. L&T, we just discussed that stock. It does have a significant exposure to West Asia. It's been very active in the Middle Eastern markets. That stock's down about 4%. There's Adani Ports, there is Eternal, there's Tata Motors, Maruti, and then the rest of the lot. Reliance is lower. There's a lot of chatter about what happens now because Reliance's refineries, when they stop taking in the Russian oil, they would be processing a lot of the West Asia crude. And now if that crude gets stuck at the Strait of Hormuz, then what happens? I mean, these are the kind of questions that we're grappling with this morning. So the losers are on your screen. Trent, Asian Paints from the consumer space, Tech Mahindra, HCL Tech from the IT space. And this is how it's playing along, at least as of now. Now I want to come to some of the other defense names because, as you would expect, upstream oil and gas companies are trading higher and defense has a sentiment boost to it, at least as of now. So if you look at defense names like IdeaForge, which is the drone maker, stocks up 3.5%. Astra Micro is up 3.5%. Bharat Dynamics, which makes a lot of warheads and also these loitering munitions, that stock's up about 3.5%. Data Patterns, quite a few of these PSU companies, PSU and private sector, both sides. Defense stocks are gaining. Hindustan Aeronautics also up about 1% as we speak. So that's one trade that's playing out very, very clearly. The other trade that's playing out is HPCL, BPCL and IOC. So those are some of the losers, as you can see. Now let's move on and show you what oil marketing companies are doing. HPCL, IOC and BPCL are all down 4%, as you would imagine, because oil prices are up 5%. So sentimental hit coming in over there. Apart from these names, let's fire up Fino Payments Bank. Fino is down 8%. We didn't get a chance to talk about the other stocks in news today, but Fino must definitely be on our radar. The MD and CEO was arrested on some investigations that are ongoing in a GST related case. The bank came out saying that he actually has no connection. This has something to do with some other vendors, and it doesn't really have anything to do with the bank. But for what it's worth, it's a big sentiment hit. Can we get Fino Payment Bank on the screen, please? It's down about 7.5%. So those are some of the stocks that need to be in focus. Mid-cap index down 1.5%, Bank Nifty down 1%, Nifty is down about 1.2% at this juncture. That's the first glance. We'll keep firing more gainers and more losers for you. On the gaining side, actually, it's all commodities. So ONGC, even metals are higher. Hindustan Zinc, Hindalco. So there seems to be a clear move towards hard assets and hard commodity assets. So those are stocks that are up. MCX is higher. In general, commodities are in favor. People are trading more commodities, whether stocks or actual real commodities. So MCX seems to be benefiting from that, 2% up over there. Some of these wire and cable companies are doing really well. The ones that our guest just pointed out, what he was just talking about. So KEI is actually up 1%. Polycab is up about 0.5% as well. So most of these stocks are in the green. That's how it's playing out for now. More stocks coming your way, but for the time being, let me bring in Anubhav Sahu as promised. He's the lead analyst at Moneycontrol Pro. Abhinav, thank you so much for being with us. So we've got the market opening now done. It's actually not too bad, right? It could have been any morning, right? Just 1% lower on the Nifty. But what have you made of all the weekend developments? And from a stock and company perspective, what is the added analysis that you can share at this point in time? What should viewers and traders and investors, what should they be watching out for?
Yeah, thank you, Surbhi. So you're right. The opening reaction of market is not too aggravated as one would have feared. But directionally, if you look at the sectoral movements, etc., I mean, they are almost in the same way as the way the sectoral movement would be when the oil prices are expected to be quite high. So in the run-up to conflict, we have seen that the Brent had already moved up by $7 to $8, and today morning it's up 5%, lower than what the street was earlier fearing. I think that the key concern for India as well as for the global economy is on the inflation part, because a lot of it that will actually seep in through the oil channel factor. And that's because that a significant part of oil supplies actually pass through the Strait of Hormuz, which Iran can possibly blockade. In fact, as we speak, there are already a number of shipping companies have actually started avoiding that space. LNG supplies have kind of halted. Underwriters are not covering the transit this thing. So that impact, it's a wait and watch thing, and let's see how the conflict actually moves on from here. But of course, at the other end, they say expectation that probably the conflict will not be very prolonged, given that the top leadership has been eliminated there. And Trump, in last 1 year, we have seen that publicly has stated that the US doesn't want to get into a prolonged conflict. So they would find a solution, and there are domestic reasons for Trump to act that way, because if the inflation gets out of control because of oil prices, then it will have limited option available for Federal Reserve to cut rates, which already is in a kind of wait and watch mode, given the strong consumption spending in US and the recent data pointing to us a kind of a stability as well as the inflation numbers are concerned. Now, coming to sectoral impact, of course, the key impact, the negative impact would be all those companies which either get the raw material from the oil derivatives or use it as a feedstock. So whether it is a chemical, pharma, API companies, oil and marketing companies, tire, paints, and etc. Those, and that's what we have seen in the initial reaction. Also, there's a mild negative reaction, not too much, but on the positive side, it's a very limited space. Only the upstream companies probably can benefit. But then we have seen in the past that how much government actually allows to benefit from that. That needs to be seen. And of course, there's a structural case for defense stocks. So today is a sentiment push for that as well. And we have seen in past that, particularly from the US side, when they came up with a security policy note wherein that they want to focus on Western Hemisphere. So already we have seen that we have.
Yeah. I also have Kunal Shah joining in. Let's see if we can connect with Kunal. And of course, he's been tracking the commodity markets for so long at Nirmal Bang. Do we have Kunal with us? Let's get him in. Yes, Kunal is there. Good morning, Kunal. Sorry, a little delay. It's all over the place this morning, right? We've got just so much news to digest and so many market reactions to take in. But 2% on gold, 4-5% on oil. You wouldn't imagine if you told me that, I wouldn't tell you there's a full-blown war and missiles flying all over the Middle East. But what's your assessment? Is this the first reaction? Is this the worst phase getting priced in over? What do you make of it?
Okay, so now at first I'll let us speak about oil. Okay, so after the closure of Strait of Hormuz, there was an expectation that the 20 million barrels of oil supply is going to get affected. As of now, 4 to 5 million barrels of supply is affected. Okay, so that's the reason why we are seeing a tepid reaction right now. Now everyone wants to see whether this war continues for a longer period of time or whether it's a shorter phenomenon, because the supreme leaders have been killed by the strikes, whatever US and Israel have did it. So now going forward, how the entire transition is going to take place, whether it's going to be a 15 days, 1 month period gestation, or whether it's going to be a weekly affair. So that the time will tell. But the markets are indicating that as of now, the fear of the supply getting out of the market and full-blown oil going up to $100, that kind of scenario is not definitely on the cards. And that is how the prices have behaved today morning. I woke up at morning and I saw prices, it was up by 8.5%, and now it is up by just 4.5%, 5%. So I believe that the markets are not still pricing in the full worst case scenario, and as and when there is a progress on this war, what we see, then we will come to know, whether we are going to see. But as of now, the trend is definitely on the upside, and I will not recommend to short anyone. The possible trade on oil is definitely on the up move, and WTI can test $75 to $78, and Brent can test around $85 kind of level. That is the conservative base case scenario.
So, Kunal, I guess this all boils down to for how long the Strait of Hormuz remains shut, right? Because as of, I think, late last night, what I saw was that ships are piled up on both sides. Obviously, no one wants to transit. So that is the only risk, at least as of now. We haven't heard of any attacks being launched on oil infrastructure in that region. So what are the different scenarios? I mean, just play out the scenarios, because yesterday some people were saying it can cross $100. I mean, I don't want to be a fear-mongerer here, but what are the various scenarios we should be aware of?
Okay, so first, if Strait of Hormuz is completely blocked and even the oil is not even going to China, that is the first scenario. If that is the scenario, and if there is a 20 million barrel oil which is passing through this channel, it is completely getting shut, let us say for 7 to 8 days, then I think there is a strong scenario that oil will again go to $90. That is a base case scenario, because then market will start to price in that this is going to be prolonged, and if it is prolonged, then so right now each and every country have enough stockpiles. But what if there is a choking of this supply for a longer period of time? Then I think the market will suddenly start seeing the risk, and oil will shoot up to $90. Now, the second scenario, if the oil infrastructure, if the oil fields are getting attacked, okay, so we've seen Iran attacking a lot of these Middle East countries, but what if the oil fields are attacked? Okay, if that is the scenario, then the oil production is going to be badly affected. I don't think so. None of these Middle East countries can afford to do that, considering. So even for the Iran also, right now, oil is a lifeline, okay? And if their production gets hampered, if they are not able to export oil, I think it's going to be a big toll on their economy, considering whatever is going on. So it all boils down to one point only. This should not be prolonged. If this is a prolonged, then oil can reach 90 and then those kind of level.
Correct.
Yeah, that's the analysis.
No, absolutely. I completely take your point. Couldn't agree more. I think, and the way the market is reading this right now across asset classes, gold, oil, equities, dollar, the way the markets are reading this is that this will not go on for too long. This will be controlled. It should die down in the next 4 to 5 days. That's the reaction of global markets, at least at this point in time. So on that, Kunal, now gold. I mean, a lot of gold bulls would have thought that this is the push needed to cross the previous all-time high. It's not happened, at least this morning. What's your advice there?
So I think gold is, before this attack took place, a week back, we've seen gold rising from $4,900 to almost $5,300. So we've seen a rally of almost $400 in gold before the attack took place. So if you see what has happened to the gold prices right now, they are just up by 1.5%. So already this was getting priced in oil. This was getting priced in gold also. Right now, the investment demand, which was the major driver of gold, so that is also likely to slow down after this price. And I am of the view that $5,500 in near term is the maximum upside for gold. I'm not expecting gold to go above $5,500. Whenever this kind of news comes that there is a fresh attack, you will see a $30-40 spike, and again it will go down. Because I think a lot of these geopolitical news are already priced in, and if there is a cool off, then gold will start sliding down. So 5,500 maximum on the up move, and on the downward it can again gradually come to 5,000. So I'm not bearish on gold, but it is already discounted this move. So that's the reason I don't advocate to buy gold at these levels right now.
Okay, so no gold. What else? I mean, commodities, we're seeing, at least on the equity side, there's a move towards metal stocks. What are the other trades that you'd recommend?
Metal looks,
precious metals, gold we discussed, the silver.
Metals looks pretty strong to me.
Yeah, go on.
Their own merits. Yeah, so metal is something what we should eye on whenever you see this kind of dip in the market. That in metal stocks, in metals, this should be used as a good opportunity because the production is the similar thing is happening in metals the way it took place in silver, like copper or aluminum. The Chinese smelting capacity is going down. The concentrate production is flat from last 4-5 years. So if you want, this supply disruption is likely to take place. I think the metal is a better way to play. And I remain constructive on the outlook of copper. I remain constructive on the outlook of aluminum, zinc. So these are the commodities which are likely to do well. And vis-a-vis, I will avoid the volatility in precious metal right now. And I'll recommend to go long in base metals.
Okay, all right, got it. Kunal, thank you very much for the conversation. Helpful, quick first take. And let's see how this plays out. I think the sum and substance of our discussion with you is that if this is not prolonged, then things should settle somewhere around where we are at. But if it crosses, say, a week, then this could be a bit of a different phase that we're looking at. Kunal, thanks very much. And trust me, we'll keep coming back to you through this week to make sense of everything that's going on.
Always my pleasure.
In markets and geopolitics. Thank you. Thank you so much. You have a great day. Thank you so much for joining in. Okay, with that, we've got Anubhav, and he's been waiting patiently. Anubhav, of course, we had to just quickly do that small digression for a specific commodity conversation. But on stocks, so you've pointed out some names like defense, L&T, of course, though they're on our radar. Actually, we didn't talk about auto names. Everything has been, hijacked by geopolitics. But a lot of auto companies came out with their monthly sales reports over the weekend as well. How did those numbers look to you?
Yeah, absolutely. The latest numbers, were quite encouraging across these segments. I mean, not only passenger vehicles, even for tractors, commercial vehicles, and two-wheelers. And which kind of says that post GST cut and beyond the festive season, they continue to do well. And what my colleague who is covering the auto sector tells me is that the inventory levels are quite lean for most of the auto players, and that's also kind of contributing to that. The only caution which she mentioned is that is regarding the tractor segment, because down the line probably it's possible that the monsoon may not be that great because of El Nino effect, and that can reduce the demand from the rural side. Otherwise, things looks good for at least for the current quarter.
Okay. By the way, I just want to point out that there's a very sharp recovery now in the market. The Nifty opened with about a 500 point or 300 point kind of a drop. The pre-open, it was down 500. The open was down 300. And now the index is down just about 200 points. So that's a cut of less than 1%. It's looking a lot better as we speak. And all these stocks, they're now curtailing their losses. So Interglobe Aviation, L&T, all of them are slightly off the lows. Even something like an Adani Ports, Asian Paints, Tata Motors passenger vehicles, we were just discussing auto names. Tata Motors PV started with a huge drop, which seemed a little strange because the numbers didn't look that bad. And the stock is now recovering quite handsomely. We can take that on board. And then, of course, you have the standard gainers, BEL up 1%, Hindalco up. By the way, ONGC has now given up most of its opening gains. You can argue that ONGC already rallied quite a bit. ONGC performed very well in the last 2-3 weeks. So maybe the market is being a little measured. That initial knee-jerk trade is out of the way. People have booked their profits and they're kind of moving on. So there seems to be a lot of profit taking. ONGC is at a 52-week high, and traders are being nimble, as one should be in a market like this, and they're being very quick to take the profits off. So that's what's playing out. Metal stocks are up. Hindalco, Tata Steel, JSW Steel, all these stocks are higher at this point in time. Let me quickly do a check on some of these names on the defense side as well. Look at the way defense stocks are rallying. Let's pull all the defense gainers up. Idea Forge, the drone maker, is now up 10%. 10%. There's Astra Micro, which is up 3%. Bharat Dynamics, BDL, is up about 3%. Data Patterns, BEL, Hindustan Aeronautics, all of those stocks, they're up for you on the screen. And they're having an excellent morning. Zen Technologies is also turned around. It's up about 1% as we speak. So defense definitely seems to be a sector of choice today. And I guess, Abhinav, Anubhav, that's kind of par for the course. We were discussing this earlier, right? There's a sentiment boost here, but I'm not sure how many of these companies are actually right now, significant exporters to the Middle East of any kind of defense equipment. Any thoughts here?
Yeah, so that I'm not totally aware about as far the Middle East exposure is concerned. But as I said, the structural case for defense spending has has increased for all the major economies of the world, given partly because of the geopolitics run by Trump's administration. And we have seen that this spending not just for Europe, but even for the allies like Japan, Taiwan, Korea. Those have also kind of busted more spending in this counter. And so it opens up for Indian players. It definitely opens up export opportunity as well because of that.
Okay. All right. Thank you very much, Anubhav, for joining in, giving us some perspective and the Moneycontrol Pro research pieces on what we've seen over the weekend. Of course, you can go on and do become a subscriber of Moneycontrol Pro for a lot of these insights that you will find out there. Thanks for joining in, Anubhav. You have a good day. Well, with that, let's introduce our next guest on the equity side of things. And we have Maulik Patel now with us, who's head of research at Equirus Securities. Maulik, good morning. Thank you so much for joining in.
Good morning.
We really thought that we will discuss the takeaways from the Q3 earnings season. We thought we'll talk about earnings and what lies ahead. But I actually have to start with geopolitics because that's center stage now. What do you think of the market reaction, Maulik? It seems to be really measured across the board.
Yeah. So I think if you look at, and it's been little like buy on rumors, sell on news kind of, the way the market has behaved in this last 15-20 minutes or so. And that's not across in India. If you look at it in the commodity side also, gold, silver, crude all went up and in that time they opened it significantly and given up the gain. If you look at some of this oil and gas global ETF like XLE, right? That index is up by 22% year to date. So globally, there's a significant positions has been built on because of this. US was building the military assets in the Middle East and in anticipation of that. So this is more like a classic sign. Market today believes that probably it will 1 week or 2 week. The war will get over and things can become a much more normal what we had seen in the past. But obviously, so if this conflict extend beyond couple of weeks and oil price goes above 80, that's what. And if you look at the last year high at the time of the 12 days of war between Iran and Israel was around 80. Today also market opened at around that level and the oil came down to around 76, 77. So if that goes above that level and you see some more built up uncertainty, then probably we may have a further downside. But today, as of now, what market is believing the things where book position has been built, conflict will not extend, beyond couple of days, and the trade flows will normalize.
Okay. You know what, Maulik, allow us a couple of minutes to really understand what the oil market is looking at, because I think that is the key as of now. What happens to oil prices, right? And a lot of our analysis for Indian equities also will stem from there, because a huge oil shock has a big implication on everything, on our macros, on our fiscal deficit, and of course our equity market. So allow me 2-3 minutes, because we have a foreign expert joining in to talk about exactly that, just oil and what should we be ready for. And then I'm going to come back and we'll continue with the rest of our earnings conversation and how portfolios should be shaped up. So for the time being, let me quickly bring in Peter Maguire into the conversation as well. He's a long-time watcher of commodity markets, of course, gold, silver, crude, and so much more. Can we have Peter on the screen, please? Good morning. Good morning, Peter. It's such a pleasure to be connecting with you on Moneycontrol. We've spoken on CNBC TV 18 for so many years, and I'm so glad that you're with us because Moneycontrol viewers this morning want to figure out that the oil market seems to be feeling okay. Just 4-5% up when there are bombs and missiles going off all over West Asia. What do you think of the reaction?
Well, it's as you unpack it, this is live, Surabhi, and good morning. I'm a little bit further along in my day. We're now at 3 p.m. or 1500 out of Sydney, and we've seen dramatic trade since Asia opened and the crude oil markets opened at 10 o'clock Sydney time. So we've had 5 hours. They spiked to the upside very aggressively, up the best part of 8 or 9%. We were through $80 for Brent. 73, I suppose, or 74 for WTI, and they've given off some of those gains. Those gains have been evaporated, so the volatility's been stripped out, or the price has been stripped out, and other markets also. Gold had a big rise. So it's early days, and this is the issue. Are we going to see this extend for a number of days over this week as far as attacks and intensification or intensify? Or is it going to subside? And no one knows that, Surabhi, and that's the dynamic nature of these markets. So I feel as though that I'm wanting to see the impact it has across Asia zone, then into Europe, then naturally into US later today.
So, Peter, okay, let's build some scenarios here. The scenario right now that the market seems to be working with is this is contained. Though, of course, the US president has vowed to avenge the death of US soldiers. So there's still a lot of commentary coming through. But the market seems to be believing that this is not going to spiral out of control and that there won't be any attack on oil infrastructure in the Middle East. So what's the price scenario if that plays out? And what could potentially be the price scenario
if that plays out, then I would expect
if this becomes more prolonged?
Well, that's the $64 million question, isn't it? You know, if this was to be contained and we don't see a spike as far as activity from a war in the sense of missiles and it just starts to subside, then I'm sure that the crude market will probably trim off a couple of dollars from here. But the unknown is retaliation. What can happen? No one knows the future. And this is the great unknown when it comes to when you see these markets. They are so dynamic. We understand 25% of all crude flowing through the Strait of Hormuz, the impact as far as a choke point, where's it going to lead to as far as airlines, countries like India, China, all of these factors have got to be worked through as well. So if it intensifies, I think that the price will significantly go up from here, but we've got to wait and see if it intensifies.
Yeah. Just purely in terms of demand and supply, Peter, I mean, how well supplied is the market? Because we had that statement from OPEC Plus on Sunday that they're looking to increase production. A lot of those OPEC Plus members are in the region. So if the strait is shut, then I don't know how the production increase helps. There are pipelines, of course. So just, I'm talking pure hard demand and supply. What are we looking at over the next couple of days?
Well, first off, yes, there is the basis of it, Surabhi, is that there is plenty of supply and they're going to increase that supply. You made a very, very valid point. Yes, there are pipelines, of course, but what about all the ships? What about the millions of barrels that get in sea cargo that get moved 24 hours a day, 7 days a week? You strip that out of the market, and then all of a sudden now you've got major concerns as far as electricity, power, what it does to an economy. It really holds the world to ransom. And this is the great challenge that we face. So there are multiple supply chain issues that you can look through all of these lenses, and it's the disruption narrative is very, very valid because it's got so many tentacles across the whole fabric of the global economic situation.
So give us a range, Peter. Next, I know this is a hard thing to do, maybe a bad question to ask as well, but base case scenario and then worst case scenario, what are we looking at on Brent oil?
Brent, I think best case scenario would be 70 and maybe $1 or $2 cheaper, but it'll be a point in time. I think it'll be a couple of weeks until it gets to that sort of level. And then from the worst case scenario, as far as intensifying all those ingredients, then you're going to see crude and Brent probably that $85 to $90 range, quite simply because from a disruption standpoint, and that's the unknown leading forward. If this was really going to unravel and be very, very dynamic, and you're talking huge amounts of military action on both sides, then you could probably, it'd be triple figures.
Yeah. Well, let's hope it doesn't get to that. Quickly, last questions on the other commodities. I don't know if you track natural gas because we are huge buyers of that Qatari gas here in India. So it's a real concern. What do you see ahead for gas prices and what do you see ahead for gold? Again, gold is up just 2.5% this morning. It's already had a massive rally, so maybe people are being a little measured. But again, I mean, what would your best case assumptions be at this point?
Well, I think gold's got more potential and it really shot to the upside. It was very, very dynamic in early trade. I think it was up the best part of $140, $150 there at one stage, went through 5,400. And I would think that it's got more momentum as this week rolls forward. There's a lot of ingredients that goes into the price of gold, and it may well take out its all-time high in this particular situation over the month of March. And when you're talking about nat gas, yes, the second largest supplier in the world being Qatar, the impact that has to the likes of India as far as LNG and so on, these are really monstrous issues that have just got to be either played out and seen from a timeline perspective, the impact that has naturally to price and to product. And if you can't get the product out, then naturally price will go and it will boom to the upside.
Yeah. Well, we hope this resolves quickly. We here in India are probably not trading tomorrow. We have a local holiday, lovely festival called Holi, the Festival of Colors. And we'll hope that when we come back, the color will be more green than red for global markets, for commodity markets, and of course for the Indian market as well, Peter. Thank you. Thank you very much for joining in. This is helpful context from your vantage point in Australia, how you see these things play out. Thank you for being with us. Have a good day. Have a good rest of the evening.
Thank you, Surabhi.
Thank you. Maulik, thanks. Thank you very much for patiently listening into that conversation. I don't know if you could hear most of it, but that's the commodity construct, right? So let's start right there. What are you telling, investors to do with commodities? Because it's just been a whole move towards hard commodities. We saw that in 25 and it's continuing in 26 for one reason or the other. It could be AI, it could be geopolitics, it could be whatever. It's just commodities all the way.
I think it's the important part you are missing is the dollar. It's all driven by the dollar index. Now the dollar is breaking that 15 years of bull market, right? From 2010 to 2025. And that's is driving the massive amount of flows to the alternate assets like commodity, EM. Then obviously you have an AI play, and that in AI play, funds and foreigners have played with South Korea, Taiwan. Unfortunately, we don't have any large companies which are geared up to do AI, where we have few small companies. Commodities, again, this prices has gone up. Gold, silver, copper are all above that 2022 high. Copper has an element on an AI side. Uh, Aluminum and few others are still below 2022 high, but eventually they will catch up. Why? Just because the dollar is falling from this market. And historically, whenever that happens, there will be massive amount of money moving to the some asset class, either it's an EM, commodity, or anywhere on the debt side. So what we are looking at it, that's going to drive. People have underinvested in the commodity over the last many years. The capacities are hard to come up. There's some kind of a supply deficit. The largest consumer of the commodity is China, and their slowdown, the commodity market has actually withstand this Chinese slowdown, right? If you know that 23, 24, the prices were very, very subdued because of the Chinese economy going very slow. So in my view, I think that required to be some allocation to commodity, and it's must. What has not worked out that a great extent is in the steel companies, right? And again, the steel prices have gone up a little bit, but there's a huge global surplus steel capacity. Iron ore prices has not moved out. It's still at around $105 per ton compared to 140, 50, which was high in 2022. So what has not moved out is this one, and eventually they will catch up because the flows moves in one direction, and then this within the sub segments start catching up. Within the oil so global surplus in oil. There's no doubt on that side.
No, so in terms of stocks, Maulik, my question was, do you have an overweight? No, Maulik, my question was, from an equity perspective, do you have overweights on metals or, I don't know, upstream oil and gas, OMCs? What are your calls on these commodity-related stocks from an equity perspective?
So we are very bullish on OMCs. We have been on a long on OMCs because we do believe that the oil has a lot of surplus. They face some kind of demand headwinds because of the EV, China slowing down, and it has been in a laggard in the last year. So far, this conflict has taken some price increase, but we do believe that it's surplus market and will likely to be there. There's another US election in midterm election is there. So obviously, President Trump do not want that price to go very, very high when they enter into the midterm election. So for this calendar year, I don't think the oil is unlikely to go above unless this conflict goes at a much larger scales, and probably then in that case you may have some time. Metal stocks, yes, some of them like Hindalco and some of this like Lloyd Metals, which is we are very, very bullish on that stocks.
Okay, so two quick questions, Maulik, before we wrap up today. One, let's talk earnings, because coming now to your Q3 report card, it seemed very optimistic, and I think more than 35% almost companies which are under your coverage, they saw earnings upgrades. And your note also talks about how small cap earnings, mid and small caps, they're doing better than large caps. So that's very heartening to hear. So on earnings, what are you penciling in for Q4 and more importantly, FY27?
So we had a tough time in a couple of quarters from I think FY25 to the Q1 FY26, partly because of the GDP was going slow, and then there was some kind of credit issues. I think since April 2025, when the RBI started cutting the down, I think things have little improved. The earning growth has picked up a momentum. We believe it will further pick up the momentum given the nominal GDP start growing now, given that those kind of commodity inflationary things are there. As you know that the last year, and even the 9 months nominal GDP growth has been very, very weak. So small cap within that, where we are looking at a significant growth is in a consumer durable, EMS. Obviously, some of them have beaten down badly, but in terms of an earning growth, they will continue to report 30-40% kind of a growth. NBFCs, what we like more on a FMCG side, some of these names where there were trade disruption at the time of this GST regime, this in September cut, but now things have improved a lot. Some of these auto ancillaries we liked a lot. So I think whole broad of that, and small cap is in a very large universe, right? So you will always have some of the subsectors or the stocks which will continue to report on a very strong number.
So Maulik, now the basic question, what next for this market? It's been a tough many months. The Nifty is struggling around the 25,000 mark. You're saying earnings are picking up. So over the next 6 months, what do you see ahead in the market, and what's your recommendation to investors? Where should people be deploying money on days like today when people are looking at building up their investment portfolios? Which pockets should they look at?
Obviously, just beginning, I think one need to take a little measured view whether this conflict is going to last or not. And we have one beautiful report on an oil price just a day before this last week on Thursday, and where we have analyzed this 50 years of conflict with this conflict. The minimum oil price movement just before the start of the war to the high point is around 25%, right? It goes to as a 3%, 100% in 1970s or around 1990s. So I think today is not the day to park your money. It's not just like it's a panic and the market will recover. We need to things to settle down, how things are going up, because today the market move is more about also positions. On a medium to longer term, definitely we are at what 21 times. I think probably can be another 5-7% downside at max if this crisis get escalated. We will remain underperform in the current dynamics, given that other markets looks very strong, either on AI or on the commodity. And for India to get a lot of FII flows, right, which has been a key concern from the market perspective, the outflows has been massive. If you want to get an FII flow, others have to not to do so good. Things has to change globally, which make India more attractive, either on the time correction or the price valuation correction, or something which this commodity bubble burst, the AI bubble burst, right? And then India looks good. So we probably will have a couple of more quarters where we'll move in this range. And then once we cross 26,300, which market has taken a multiple attempt to cross, and they have not been able to do that. I think once we cross that, then things will look better for that.
Okay, all right, Maulik, thank you very much for being here. Next couple of uncertain days, I think, till we have some clarity on what's happening with geopolitics. But at least earnings are a silver lining, and they have been picking up, and we'll hope that trajectory really continues. All right, thank you for being with us.
Thank you, bye-bye.
Let's quickly glance back at the screen. Thank you. Before we introduce our next guest on the show. And the screen is telling us that it's still about a 1% drop. That's where this Monday morning has settled with all of that weekend news flow. The mid-cap index, by the way, has shown a very good recovery. So that's the Nifty. Nifty is down 1%. Now look at the mid-cap index. The mid-cap index at open was down almost 2%. And now it's down just about 0.6%. That's the Sensex. Pull up the mid-cap index. It'll come up for you in just a bit. And yeah, so mid-caps are doing really well on a morning like today, you'd have to say. Let's look at some mid-cap gainers. We know what the losers are. I mean, we know a lot of the OMCs, etc. are down. But if you look at gainers, then you're seeing metal stocks, you're seeing some NBFCs, you're seeing a lot of defense companies like the ones on your screen, Solar Industries, Bharat Dynamics. So these are very active mid-cap pockets today where the gains are coming in. MCX, like I'm saying, commodities are such a popular trade, and MCX seems to be benefiting from that. Higher trading volumes on MCX for sure, and that's showing up in the MCX stock itself. Then you have more names like IIFL Capital, Astra Micro, Tejas Networks. I mean, everything in defense is definitely up, almost everything. Dynamatic Tech, what else? Mishra Dhatu. A lot of metal stocks are also higher, at least at this point in time. So those are your top mid-cap gainers. Let's show some more stocks if we can. Keep flipping it around and show more of these gainers. So it's not a bad screen at all. Those are some of the key losers. And in losers on the Nifty, we should keep an eye out on L&T. That's the one that's taking a big hit, down about 4.5-5%, because of its exposure to West Asia, which is where it's been winning so many contracts on the hydrocarbon side. And that's where, I mean, there could be a question mark till this resolves. So L&T obviously is the big large cap casualty. That's the one that's down the most. And then there is, of course, Interglobe Aviation, which is lower as well. other stocks on your screen. Let's flip this with the Nifty now. Nifty losers and gainers. Losers, like I said, Asian Paints, L&T, Interglobe. Asian Paints, you can imagine it'll be lower. It's a paint company. Crude is a very important input, and if crude prices start spiking higher, then obviously it's not great news, which is why Asian Paints is down about 3% as we speak. A lot of auto names are actually weak as well, though February was another very decent month for sales for most of them. But still, some of the numbers will shade below expectations, and then there's general risk off. So there's profit taking in the entire auto space, Maruti Suzuki, Bajaj Auto. Most of these stocks are on the lower side of the screen as we speak. Okay, and that now brings me to IT. Let's look at what's happening with IT actually. Let's fire up IT gainers and losers and see what they're doing. Infosys is down about 0.25%. HCL Tech is down about 0.25%. TCS is down about 0.5%. And Wipro is down about 0.5%. So mild cuts continue on IT stocks. So we're shifting gears now, shifting the focus, and let's get back to IT. And that's a question that one of our viewers had asked earlier in the morning. Can IT now start providing some support to the market? Well, we have someone joining in now who has been tracking the Indian IT landscape for many, many years. He is a consultant and he works with EY, and he has been consulting with a lot of the large Indian IT services companies over the years. Abhinav Johri is our next guest on the show. Abhinav, thank you so much for joining in. Apologies, the timing went a little haywire because, well, Israel and the US decided to do what they did over the weekend. So coming to you a little
yes,
late.
Yes, indeed. Good morning, Surabhi.
But,
yes.
You know, it's actually... Good morning. But it's good to kind of pull back. We've discussed a lot of geopolitics and commodities. But let's pull back because before this news hit us, all through February, we were grappling with the severity of this AI disruption and whether Indian IT can weather the storm or not. So let's actually start right there. I want to start with your opening thoughts on what you have made of this massive fear in global markets, even in US markets, that AI and AI companies are going to take away everybody's jobs. They will disrupt SaaS companies. They will disrupt, traditional cloud players and basically cybersecurity companies. That's what's happening right on Wall Street itself. That it will just be OpenAI and Anthropic. Everybody else will not have a business anymore. What do you make of this big fear, first of all?
So great, Surabhi, good morning again, and thanks for having me. It's interesting. It's interesting how the narrative reshapes itself when technology, matures and there's something new on the deck. Well, there's a reality to it. What's being said, what's being told, but then the reality has to be understood in a context. AI is certainly going to be replacing jobs, but perhaps where people stop and do not say that what are those jobs, and we all know this is not the first time. If you think about it, AI is the first technology which has the capability of automating the technology itself. We haven't seen this before, which means that bunch of jobs which were more transactional and everybody understands it, which were pretty much engaged in building up the technology, those are the jobs which now make sense to be done through AI. However, like the way I always say, and we continue to confirm this understanding in the market, that what is needed more is that people who appreciate and know where to use AI. So in short, if I were to keep survey, AI will certainly replace people, but AI will not replace people who know AI and where to use it. So there's the reality to it, and I think that's how we should understand about it.
Absolutely, and all of this just continues to confuse investors pretty much around the world. So, Abhinav, I want to spend the next couple of minutes to try and understand what Indian IT services companies are doing. All of them are making the right noises on AI. Some have started giving out their AI revenue piece separately. Others are saying we can't give it separately because ultimately all our service offerings have to have AI embedded in it. So, what's going on with this grand pivot that Indian IT is trying to make?
Well, I think the right way to look at this is that we should think about what's the impact on the large cap, mid cap, and the small cap companies. Fortunately, as a service-oriented economy, our IT services landscape is also pretty fragmented. Now, 3 or 4 things will happen, Surabhi. One of them is that AI will definitely not eliminate the large firms. I mean, that's something which is what people are talking about. They're really scared about. But certainly what will happen is that what defines large, that's going to change. And we know that for many, many years, the tech services organizations have been working on billing the bodies, billing the resources. That's going to shift towards billing the outcomes. So from resource-based billing to billing the outcomes, that's a major shift. And one can imagine if somebody is out here who runs such a tech company, it can imagine that in order to make that shift, there are fundamental changes which needs to be also brought in the way companies have been operating, which means that we need to look at the way we contract. We need to look at what our people do for our clients, meaning how much of them are building technology versus how many are thinking intelligently about the technology in context with the business domain function, so and so forth. How much transparency can we really bring in our outcomes? We all know that most of the large IT contracts have always been about volumes. But then this is going to be shifting from volumes to outcomes, like the way I mentioned. But can I demonstrate a clear line of visibility what those outcomes really mean? Can I sign up a contract which caters to specific KPIs, and I do have an observability attached to those KPIs wherein I'm able to show this is how I'm able to move the needle, which means that I'm no more bothered about the large sign-up values of the TCO, so to say, but then I'm now going to be rewarded based upon what I'm delivering and making an impact. And the couple of points also which we also believe is coming in fast is what happens to the outcomes. Is it for the client? Is it for the service provider? Is it shared? Is it co-developed? So and so forth. So the contracting itself is a huge problem area and an area for innovate on how this needs to be delivered. The couple of other points which the large
so, I want to ask
yeah, go ahead.
Yeah, sorry. I'm just trying to simplify it as much as possible. I'm going to ask very basic questions.
Sure. Okay.
Do you see Indian IT companies losing business in the interim till they figure out what their new model is?
No, I don't think so. I think that's a bit of a, I would say, fear in the market, but doesn't. See, we need to also appreciate the companies the large Indian IT companies have taken decades to build the scale. Now, will they really lose the market share in the interim? Not at all, because that scale is not immediately available even with the most innovative firms out there in the market. What large-scale companies do provide you? They provide you an enterprise trust. They provide you scale delivery. They provide you an integration capability and global presence. So the way they will shift, and many of them are really pivoting it now, that they are bringing this scale to the client with the niche providers who bring verticalization or depth in a certain domain and function. So it's a two-in-a-box model, Surbhi. I don't think so it's binary. We are not seeing it. Most of the commercial models are now two-in-a-box. So that's the right way to perhaps see this evolution of what's going to happen to the large companies in the near future.
Okay, so one more quick question. How should investors now start understanding or thinking about valuations of these companies in the new AI era, the AI new model, right? Because, and there's such a fierce debate in the market, I can tell you. I spoke to some people, some are saying that they should trade like utilities now because they will only use models built by the original IT, AI giants like Anthropic and OpenAI, and everybody's signing those deals. The big IT guys, so they'll only use their models and provide some service. So they should trade like utilities. And there are others who don't think that it will be that big a valuation drop. So just help us wrap our heads around the new valuation or the Indian IT services model.
For sure. So just confirming to what you mentioned, Surbhi, that it's true that the large, let me say that big AI labs, the one which you mentioned, they are the true providers where the magic happens. But then hasn't been the case with the history and the OEMs who have been building commercial scale products. Well, from the investor's perspective, the important point for every investor to evaluate their prospective portfolio they will look into is that how is the delivery economics of that organization is changing. And I'll give a couple of examples to talk about it, but I'll just complete some of the attributes. So I would say that the organizations which are showing and also are talking very openly about that they're okay to cannibalize their own revenue at the cost of their people using AI or AI getting embedded into the client deliveries, they are the companies who are pretty serious on delivery and on changing the way they operate for clients, which means AI by design. those organizations will show a promise in the economics of the delivery. And we must all continue to remember this business has always been high volumes, low margin. This is progressively shifting perhaps to less volume and higher margins, and maybe a margin share with the clients as well. So these are some of the elements which investors can look into, and there are bold CEOs out there who are making now very open statements about how open are they about the employees who are using AI for their clients and for themselves. Second is that even if the large AI labs are continuing to build large language models or the capability which makes everybody an AI-fied organization, the large organizations do still have a lot of IP with them. And we must remind ourselves, the large IT companies, even the mid IT companies as well, mid-size IT companies as well, they have built platforms, and these platforms and products have been built on decades of deep expertise and deep knowledge about what they have been serving their clients in a variety of sectors. So the expectation is not that the companies will now start building an equivalent what an Anthropic or Google or Microsoft or OpenAI has built, but the intelligence lies that where would they deploy those models and what products would they build on top of it, which has faster time to the market, lesser time to deliver, and a better implementation. So it's about using the foundational layer intelligently, mixing it with the market and the function and domain expertise, and delivering to the client. So
Okay, that's a very interesting point, that at least some of the companies that really make that AI pivot could see a shift from being a high volume, low margin business to actually a lower volume but higher margin business. And those businesses would perhaps be fetching better valuations as well. Yeah, got it. That's an interesting one. So we'll have to watch out. Finally, Abhinav, another simplistic question that I know won't have a simple answer. Investors want to know, are we better off with the bigger guys right now in this whole disruption and transition? Or will mid-cap IT and some of the names, like entities like Persistent, Coforge, they were doing very well up until now. Their growth rates were better. So investors are wondering whether these nimble, smaller guys will be able to move faster than the larger elephants, the giants. So whom should we back?
Yeah. Well, I wish I was an oracle on that front, but then, the investors need to also think, and we also think like that when we approach our clients, exactly that. What AI has done technically, Surbhi, it has lowered the entry barrier, which means the pitches or the business propositions which only could have been proposed or served by a large tech IT company with a scale delivery global presence is no more the condition for a mid-size or a small-size IT company to go after. It's a level playing field for everybody, which means that the mid-size and the small or the mid-cap or the small-cap companies, their strength has always been domain, hardcore engineering, R&D, so on and so forth, which the large cap organizations have not really focused because they were dealing with the scale. So there are two things which will happen, and we are already seeing that in the market already. One of them is the share for a very large client engagement would be equally available to the companies of irrespective of the size. However, the nuance and the USP of that deal would be who would be able to deliver to me faster AI product on the ground, who would be able to do it with the smaller size pyramid and small size teamings, and how much verticalized can I be for my client, and how well can I bring the context. So the mid-size and the small-size organizations, they were always known for the agility, their flexibility to draw the contract they would want to have with the client, and they do not have very huge apparatus, to go after so that they can cater to the client's flexibility and the ambiguity. The mid-size and the small-size cap organization provide huge promise in the coming market, and you will see a lot of you would remember the term co-optation, a couple of years ago when we were talking about with great enthusiasm about digital. So active hiring is a new term in the market where we would see the large cap and the mid cap coming together, on the verge of a large deal and signing up together. And that agility can only be brought in by the small size and the mid cap size. So huge volume and huge promise out there with those kind of companies.
Okay, all right. I'm going to remember that. So watch out for the mid caps. Don't write them off. And wait for this transition to play out. For some Indian IT companies, this could actually be a move up the value chain, up the value curve. And that will be a very interesting transition to watch. Abhinav, thank you very much for joining in. Very helpful context. And we hope to connect with you more often to make sense of this disruption as it plays out. Thank you and have a great day.
Certainly. Thanks, Ruby. Have a great day too.
Thank you. Thank you. All right. Well, with that, we are coming to the final leg of the show. And as we do that, the market again is looking a little tentative. The Nifty is down 300 points. It opened down 300 points and it recovered to just a 200-point drop. And now it's again a 300-point drop. So just watch for the markets. Now, before this whole West Asia issue erupted, the big news for the market on Friday evening was the GDP data release. The Q3 GDP numbers were released. Not just that, we actually have a brand new data series on which GDP is placed. And there was a significant upward revision in the estimates for the current year as well. So what to make of the new series and the way we are looking at economic growth captured in this data now? We have Mr. D.K. Joshi joining in, who's the chief economist at CRISIL. Mr. Joshi, good morning. Thank you so much for being with us. And first, my apologies, sir. I mean, this whole West Asia piece completely threw us off, so we've had to completely overhaul our programming. And I want to talk about that as well, because oil becomes the latest risk that we must discuss from a macroeconomic fundamental. But before we get to that, let's get your opening thoughts on the GDP number itself that was released on Friday and what you think of the new series, the way it's capturing the data now.
Well, I think the rebasing is a pretty comprehensive exercise which looks at the size of the economy. It has implications for size of the economy, structure of the economy, and the speed of the economy. And this was particularly relevant because it's coming after a very long time, which is almost 12 years, and a lot has changed between that. So I think this new series gives you a more clearer picture and more updated picture of the economy. And I think a couple of things here. Number one, I think the growth rate for the current fiscal year has been revised up to 7.6%. Now, this is not merely because of the rebasing; it's also because new information became available since the first advanced estimate was made in January. And then second thing is that as many people were expecting the size of the economy to be larger, but that didn't happen. Actually, the size of the economy turned out to be between 3 to 4% lower than what happened in the past. But I think the most interesting development in this series is it has raised the manufacturing GDP growth. And that is because I think it is using a number of surveys for informal sector. It's also using what is called the double deflation, where inputs and outputs are deflated using separate deflators, and that actually leads to a better measurement or more refined measurement of activity, and that's led to manufacturing activity rising sharply. It's grown at almost 11.2% in the last 3 years. The previous series had estimated at around 8%. So I think there are a lot of changes in activity that we see in the series. The share of agriculture, the share of industry has risen, but the share of services has come down. So I think all these are more aligned to what is happening currently.
Okay. So the projections as they stand now, sir, how do they align with your own growth forecasts for FY26 and maybe the next couple of quarters in FY27? And where do you think the kicker could actually come in if we are to see growth closer to the 8% mark?
Well, I think for that, two things are important apart from other things. One is the oil price has to be lower, or at least it has to be under control, so to say. And the second, I think we need to get a normal monsoon. So these are the two luck factors which we don't control. Apart from that, I think the economy is in a reasonably good shape, and I think we haven't taken a call on the next fiscal year because of the events that are playing out currently. So a lot depends on how long I think this plays out. But I think somewhere around 7% seems to be the new potential which the economic survey had also pointed out. And whether you realize that potential or not depends on what kind of environment you face. And I think last year we did very well with the tariff shocks didn't impact us much. And I think now in the coming fiscal year we are entering the year with a lower level of tariffs. But I think the uncertainty that is playing out globally, that is very much there. And I think so. Right now we need to watch out for not only for the oil prices, but also I think the freight cost, everything goes up. I think because if the Strait of Hormuz is not available.
Yeah, absolutely. And coming exactly to that. So, as of last count, according to several estimates, almost 40 to 50% of our oil requirement, monthly oil requirement, was coming from the Strait of Hormuz. Now, if that remains shut, then it's going to hurt at multiple levels, like you said. Any sense of an assessment of what we could be talking about in terms of an impact, sir?
Well, I think it's a little too early. I mean, we don't know the duration of. I think if this is short-lived, then I think it doesn't have much impact. I think, but if it extends, I think then there would obviously. I think we'll have to look for alternate sources of oil, and I think we also have reserves which can last for I think a couple of months. So in this scenario, I think it's very foggy to make a linear projection right now. But yes, I think the oil prices impact us in terms of GDP. They impact us in terms of inflation. They also increase our vulnerability on the external front because your oil import bill goes up, so current account deficit sees some pressure. So I think from those perspectives, I think oil remains a very important factor for India. And as I said, I think the oil from the Middle East is all routed through Strait of Hormuz. And so we'll have to look at alternatives, I mean, for oil. I think if this continues, but I really don't, it's just a few days into the conflict, and I don't know how long I think this will continue. So you can only create scenarios right now depending on the duration.
Sure. By the way, I also point out that there's obviously been a currency impact as well. The dollar is in general higher against most Asian currencies. The rupee is right now trading lower by almost 0.5% versus the dollar. So that's been the sharp sort of reaction that we've seen. As you can see, 0.45% lower today. It's already getting towards that 91.38, 91.40 kind of a mark. And this is in sync with what most Asian currencies have done. On my screen, I can see whether it's, the ringgit or the rial. Most of these currencies are trading lower versus the dollar. So, from a macroeconomic standpoint, as we get set to wind up this year and enter the next one, if we leave aside this potential geopolitical oil situation, then, does it look reasonably comfortable? Can you sort of project right now that FY27 could be better than FY26, or is there simply no visibility because of too many moving parts?
Yeah, I think I won't venture out into that direction. I think you'll have to cross the river by feeling the stones. So I think any forecast that you make at this juncture, I think we'll have a very large confidence interval around it because the global uncertainty levels were anyway high. I think on top of that, I think the new conflict has created more uncertainties, and particularly in areas which are very critical for us, particularly the oil specifically. So I would say that, as I pointed out earlier, I think you can only look at different scenarios right now under different assumptions. But if you take this piece out, I think the Indian economy is reasonably well positioned because the government has capital expenditure which is growing faster than GDP, so that support is there. Private consumption growth is reasonably strong. I think inflation remains very much under control. I think, and there's no much serious upside to that. I think considered at the juncture. So I think the macro parameters are in good shape, and I think more importantly, what comes really handy in these situations is what is the health of the corporates, what is the health of the banks. So the balance sheets of corporates are squeaky clean. And I think the banks also have low NPAs. I think CRISIL's upgrade to downgrade ratio is at 2.1, which means for every downgrade we have 2 upgrades. So I think all these things help you during volatile times. I think so. That's why I'm reasonably confident that I think India is on a strong growth trajectory.
Okay, all right, Mr. Joshi, we will leave it on that note. Thank you very much for joining in on a sort of very newsy morning and a very important morning for markets and making sense of the macros for us. Thanks for being with us, and you have a great day ahead. Thank you. Okay, all right. With that, just a quick glance back at the screen. So 312 points lower. We're back at the lows of the morning. So therefore, need to tread with caution. You can see the Nifty is now pretty much back at the lows. So is the Sensex. The mid-cap index is also a little tentative. It's doing better than the Nifty and the Sensex, but it's still down about 1% or so. And the losers, fire up the Nifty losers. It's the same set of stocks. L&T, Interglobe, Adani Enterprises, Asian Paints, Adani Ports, Maruti, Tata Motors, Reliance is lower by about 2%. So it's all of your heavyweights which are down. Nothing much is moving up in the market apart from some metal stocks and some defense names. That's the only green area. Otherwise, you can see there's just a broad risk-off everywhere that's playing out and prices are still under pressure. And if you thought that ONGC would be seeing an uptick this morning, it's not. There's profit-taking. ONGC opened gap up, immediately profit-taking happened, and now ONGC is also flat. Nifty gainers will only be three stocks, BEL, Hindalco and Bharti Airtel. That's it. Everything else on the index is lower. So we'll keep getting you more rates. On the mid-cap screen, I just want to talk about defense. Those stocks still have some gains on them, but even there, people are being very quick to book profits because remember, this is a very uncertain market. You have no idea what the next couple of days will bring. India is not trading tomorrow, so you can't react to any kind of global developments. I mean, fingers crossed for humanity if there's suddenly a breakthrough and the war completely ends. So people don't want to carry too many long positions as well. And that's why we're seeing profit taking on whichever long trades are working well. There's also quick profit taking that seems to be happening. That seems to be the mood of the market this Monday morning. We'll keep getting you more market trades, but right now it is time for a big exclusive interview. As SEBI chief Tuhin Kant Pandey completes his first year in office, the SEBI chairman has said that they have been concerned about short-term weekly options. He also adds that SEBI saw hyperactivity without serving any great economic purpose in the F&O space. He says that SEBI will continue to monitor F&O rules and then assess the course of action.
One of the things of interest to everyone in the market has been the derivative related regulations. In the first 8 or 9 months, there were a bunch of changes that happened. Is this the level at which we sort of, rest? Or do you see more need to curb speculative activity or excessive retail trading? Do you think there is more to be done?
So I think on the derivative markets, there's a particular concern was only around index options, short-dated options on expiry day, weekly options. The rest of the market, I think, is not of that concern. So in that market, of course, we had put it out, as you know, the full study reports saying the extent of losses, and that created actually a lot of awareness around why a whole set of people were actually coming to this market and not being successful in making profits, because actually this is a very complex market, and the way it was being sold out by the so-called influencers as a market to really make big money overnight. I think that particular education has been belied, and that was, I would say, miseducation. So that is also another action on our thing against such influencers who, without a registered investment advisor license, are trying to give this advice and propagating through various social media forums is another area of interest to us in terms of enforcement.
Right.
But having said that, we have taken some measures both in October 24 and May 25, a series of 6 measures in May 25, the last of it kicked in December. And we would like to see the impact of these measures and also look at the situation from the data point of view again, and then if we find that there is a intervention necessary, we will then explore pathways in consultation with industry how to do it.
Right. Because one of the things that, a lot of people have talked about is about raising the entry criteria for participants into the derivatives market. In some of the Western countries, you need to be, have a certain, certification or be an accredited investor to even participate in the derivatives market. Do you think something like that will be under consideration in SEBI, or do you think it will be retrograde? What are your thoughts?
So that will again depend upon what kind of analysis we come forward, in what way the measures have acted. And then it will be like exploring different pathways, which might include the pathways that you are suggesting, but they are not the only pathways.
Okay. So you're saying it is not necessary right now to put any entry criteria for derivatives market?
Not till we have deliberated on this issue and worked out the thing. We can't be doing flip-flopping. And we should move consistently data-based approach and consultative approach in this matter.
All right, and the whole interview will play out in the next couple of minutes, so keep it with us. That's the SEBI chairman and that big interview coming up right after this. Thank you very much for being with us on this longer session of Opening Bell. Market's still very, very tentative, so watch the screen carefully, and we'll be back with more news and updates in the next couple of minutes.